shortly. We are now being recorded, so we are ready to go. Thank you for joining.
All right. Hey, family, how are you all doing? Hey, I'm excited about getting started with tax tips and strategies. But before we do, we always start off the same way, and that is in prayer. Let's pray. Heavenly Father, Lord, we thank you for this day, Lord. We thank you for all the opportunities that you blessed us with, Lord. I pray over all the doors that you open for us, Lord. And I pray over our finances, Lord, and let us be good stewards over the income that you bless us with, Lord. I pray over that we become debt free, Lord. I pray over how we invest, Lord. I pray that we build kingdom, Lord. And then, Lord, today we speak over our taxes, Lord. I pray our hand upon everything that we do in that area, Lord, and then also generational wealth, Lord. We say this prayer in the name of Jesus, and all the blessed people of God said, amen. All
Amen.
right, everybody. So I'm excited. We are doing as as we know, we do our series where we begin to speak in certain areas in teaching. And this is kind of I always say this. I think I say this every month or every time we do these. Is that this is my favorite one? But this is an area that really helps people in the area of understanding taxes. So if we can, before we get started, when we walk through taxes, I just want to make sure I introduce you to the team. So I'm just kind of going in the order that the people are to me on the screen. So we have Julianne right over here running air traffic control, making sure that if you guys, there's some things that we talk about today and you're saying, and you may have a question regarding your taxes or finances, then you're going to, then you can send us an email. And they're also going to put in the chat, there's an area called Work with George. So you can kind of have that, and Julianne will kind of be able to pick that up. Then right next to her, at least on my screen, is Shayna Malcolm and everything, associate advisor. She helps everything here at Thompson Wealth Management. And then we have Danette, and as you know, she's the vice president of everything. So in doing that, and then today, co-hosting this and doing this is Crystal Moselle. So first of all, she works at Thompson Wealth Management. She also works with me at Faithful Central Bible Church, and then also we have a community development corporation where also she also is the executive director of that as well. So, but she specializes at least with Thompson Wealth Management, just in helping people, but also in the area of taxes. So she'll be co-hosting today. Crystal, how are you doing?
I am excellent. Welcome, everybody. I am glad you are here because you are going to learn something today.
Gotcha. All right. So everybody, let's start this off. Can everybody give me a high five? Boom. Give me a high five. Boom. Okay. There's 5 things that we focus on Thompson Wealth Management. And number 1 is income. So you guys, and then for people who know ministry, know this is all coming to taxes. But now watch this. Number 1 is income. So we want to look at how your income works, whenever we're doing this. Then the part number 2 of the high five, 2 is a debt plan. That means we show you, and you guys that have read, if you've ever read any of my, boom, look at that advertisement just flew right by. All right, is I tell all the time to do good. What does do good stand for? Type it in the chat. Get out of debt, right? So that's income, debt. Number 3, there's an A and a B. That's investments, stocks, bonds, mutual funds, things like that. And retirement accounts, 401ks, 403bs, 457. If you haven't heard of them, IRA, SEP, Simplified Employee Pension. Those will come back later, okay? That's investments. Part B of 3 is real estate. That means owning a home. And then, by the way, Crystal, is there some, wait, you're going to cover that later. All right, there's some tax advantages to owning real estate. Number 4 is protection. That's insurance and taxes. So I'm coming back to 4. And then 5 is estate planning, having a wills, trust, things like that, and healthcare directives, and having all that in order. So again, that's having a high 5. But now, do you remember I said number 4 was taxes? But if you look at everything that I just said, income involves taxes, right? Can I have a thumbs up or something? Debt involves taxes and things like that, right? Third, investment involves taxes. And fourth, estate planning, estate taxes and probate, things like that. Those all involve taxes. So today we're going to specialize in the area of taxes. And then, hey, buckle your seatbelts. My goal is that at least we cover 7 things you should know about taxes that can help you in doing this, okay? So we're going to lead through it. So starting it off, Crystal,
Good
What is
morning.
one thing that somebody, at least, well, I'm sorry, not one thing, but what's the first thing people should do when it comes to taxes to be able to help in that area?
Okay, so the very first thing, you guys, that I advise you to do is to go to the estimated tax calculator to the with the IRS. And if we can put that in the chat, team, that is where you take your
Crystal, let me show you how good I am. Let me show you how good I am. Everybody don't even have to worry about that. Boom. Tell me if I knew it. Tell me if you see it. Tell me if you see it.
boom, there it goes.
There you go. It says I'm on IRS. And also we'll send these notes out to you later, or Danette let us know at the end what we're going to do with this, our team. But anyway, this is a tax withholding estimator. Go ahead, Crystal.
Yes, and so with the income that you have, this is the first step that you can take in planning for 2024. 2023 is gone. Those are the taxes that we're going to file. But to get a head start on 2024, you take your income. The first thing that Pastor George spoke about, you take your income and you will utilize this withholding estimator to determine if there is enough tax being withheld from your income so that you do not owe at the end of the year. Now, things shift and change sometimes. You might get bonuses, but again, this is an estimator. I want everyone on this call, like I said, you're going to learn something today. I want everyone on this call to ensure that they take their income and go to that estimated tax calculator to verify that you have enough taxes taken out of your check so that you do not owe, and it's not a surprise at the end of the year how much you do owe. Now, we'll get into a little bit later my own philosophy on how much you should owe. Well, actually, I'm gonna say it now. My thing is, as long as you can afford it, my goal is $1,000. I don't want to owe the IRS more than $1,000 because I can handle paying them $1,000. But what I don't want to do is continuously get a refund, because that means that they're doing with my money what I could be doing with my money, which would be investing it.
All right. All right. All right, everybody.
So,
I got to jump in here on this one. Is it so you guys see what number one is have the estimator and doing that. But also, you guys, can everybody, I don't know if I'm pinned on it where you see it, my hands, but you guys, you guys really want to make sure that you're paying a little bit or you're getting a little bit back. Because if you're getting a whole lot back, that means you're giving an interest-free loan to the government. You understand? People say, I got a refund. Actually, you're getting is your money returned back to you. I want to make sure you're understanding that. Then if you owe a lot at the end, then you didn't estimate it correctly. And that's why we're having this right now. So you guys, one of the things that when you become a client at Thompson Mansion, we ask you, do you have a tax professional? I was gonna say at the end, but I want to say it now. Do you have a tax professional that you're working with, or do you have a scorekeeper? And everybody's like, what's that? Okay, so a tax strategist is you're working on strategies right now. This is the month of March. We're working on these right now. A scorekeeper is you only see the person once a year. You're coming in right now, and then you give them your taxes, and you bring the whole shoebox, you bring a whole bunch of papers in, and then you give them to them. And then before you do, then some people do the whole, they start praying. And then we got the whole group that's speaking in tongue, yelling out Disney characters. All right, anyway. So what happens is, what you want to do is, we want to set up some things right now with these estimators. So we want to make sure it's like landing a plane. We come in for a smooth landing. So we want to make sure we're not scorekeeping. There's nothing wrong with, and who you work with and everything, but we want to make sure you're developing tax strategies. All right. I'll repeat that again at the end, but also, Crystal, anything else about number one?
no, nothing else about number one. Copy and paste that link and save it. And you can do that throughout the year. It's not a one-time thing. You can do that. Actually, you can do it anytime you want to. And so that's the beauty of it and technology that we have.
Okay. And then is there another one? Okay, perfect. Julianne put that in the chat. All right. And then what else should they do?
So I would suggest that on top of that, what you want to do is create a IRS account. So that is where you put your information in and they verify it. And sometimes they have to mail a pin to you to verify who you are. But this has so many advantages. The first one is you're capable of seeing any correspondence that the IRS has sent to you. It will be listed there under your account. Many of us don't even realize that that is the case. If there's something fraudulent going on, you have the opportunity to catch it before it becomes something big. So for instance, we have had clients whose information has been compromised. Someone has used either their social security number or one of their children's. That information will show you what has been filed under your social security number. You can also access prior records and any 1099s, W-2s that are due for that current year. And they normally do 2 years back that you can actually see. So that is the second thing. Create that account so that you have access to what's going on with your IRS file, and you can verify what they have received, who sent information to them, and you're not relying on the Postal Service, who has not been as reliable lately, at least since COVID. They've kind of, I don't know what happened, but anyway, you can make sure that you can verify any W-2s that you've received. You can verify any 1099s that you have received right there on your personal IRS account. So
Can you get, what about transcripts?
yes, you can get transcripts from
I'm
there
sorry, can you
also.
explain what a transcript is, and then we'll say when we need that. But I'm sorry. go ahead.
So you want me to, so a transcript is, you can do it for the year, and it gives you any and everything that the IRS received under your social security number for that year. And it's done by year. So you can request 2023 if you don't think that you've received everything that you should have from your investments, from your interest statements. So the code for that would be an INT, a W-2, which would be income from earned income from employment. A 1099 would be interest and or, well, it can be several different things, but it would be reported either dividends or income of some sort from any entity that's required to do that and give that information to the IRS. So you can use that as a checkpoint.
All right, great. And then if we put Julianne is flowing right with us, she put that in there. Is there any other? Is there then? Okay, if you live in the United States, but then let's say you live in a state, what should you do?
So if you are in, so we'll start with California because we're in California. Our tax entity in California is called FTB, the Franchise Tax Board.
Oh,
yes. And let me tell you guys, California's Franchise Tax Board does not play. IRS will give you some leniency, but California Franchise Tax Board, they're going to get their money. Come hook or crook, okay? They're going to get it. So the second one that I would suggest is creating an account for your state. For California, like I said, it's called the Franchise Tax Board. If you live in a different state, you are able to create an account with them also. And their names vary depending on what state you're in, but that would be the third thing that I would do to get ahead of your taxes and to create a tax planning strategy. And again, they'll give you the information on who's reported information to them on you with your social security number, whether it be an employer, whether it be a bank with interest statements, or your social security, it will show there. Because what happens is, guys, they have to report to the state. All entities such as employers, mortgage companies have to report to the state by supposed to be by January 31st. Sometimes there's some changes in that depending on law and what's going on and what's happening in Congress. But they're required to report that information, and that's how they verify and cross-check when you do your taxes that you've actually submitted everything that you were supposed to. So again, Pastor George, that third tax planning tip that you should do is create an account with your state tax entity.
Got it. So you guys, and just let me say this and just about what you're saying, to put these in here because these are really good to actually understand these and actually do these because you find out one things about you that can help with the information. The second thing that's really good is you guys know we teach about generational wealth here. So maybe your mother, parent, another person, you also need to tell them, share this information for them so that everything works out with them as well, just not you. All right. And then Danette, can you help me mute? I think some other people coming on the line. All right. So hey, that's some things in that area. Hey, Crystal, can you share some things or let's go on to, I know that was one, but that was kind of like about three things. But hey, the next thing we do, can we kind of share some areas of getting some deductions or kind of like deductions, things like that in that area?
Oh, that's the mama right here.
Oh, hold on, let's mute. I'm going to, okay, there we go. Sorry. So you guys can hear me. So let's actually first talk about
Oh, thank you.
gotta keep on doing it. So a lot of times what is confusing, guys, is the difference between a deduction and a credit. So a credit actually reduces the amount of tax that you owe. So for instance, it's like a dollar for dollar. A child tax credit, if for the year that's $1,000, you will get $1,000 in credit for that. A deduction is where normally you'll get a percentage of it. So for an example, for medical expenses, if you have over 7.5% in medical expenses, you can deduct there, you can get a deduction for that. And depending on how much it is and how much you made, if you had $7,000 in medical expenses, and they will give you a 10% deduction of that. So that would be $700 less in taxes that you would get. So the first thing is understanding what the difference is between a credit and a deduction. A credit normally is always better than a deduction if you can get a credit. Know this, and George said
deduction.
yes.
That is better deduction, but hey, deductions you need to, because then also that's, can I say this? Lowers your what's called marginal tax rate so that it affects it that way. Okay, guys? So
that's what I was getting into, George. But what I want them to understand first, though, is that there is the difference, and that you personally, you have to pay. George said it earlier. It's taxes that you've already paid. The goal is to reduce the amount of tax that you have to pay. So we want to take them, but we want to take both of them. It's not one or the other most of the time. There is a standard deduction, and we want to take the higher of the two. But what you want to know is that they will lower your tax bill, but they're only going to lower it by how much tax you paid. So if you paid no tax, you're not getting any, there's no deduction to be given because you haven't paid any. And I think for us, sometimes it's kind of confusing because I hear it all the time. Well, I didn't get a refund. Well, how come I didn't get a refund? Well, if you're making $500,000 and you only paid $2,000 in taxes, you didn't even meet the minimum. So you're going to end up owing because you fell into a tax bracket that required 22% of your income to go into taxes. So can you guys just respond? I want to know that you're understanding what I'm saying, because we definitely have, I'm here to help you understand. But while we're having this conversation in the lounge, I just want to make sure that you're not confused.
Right. And then also everyone, you can say something verbally, or if you want to, since people we mute a lot, can you just type in the chat, I get it, or that's cool. Hey man, that makes sense, or in that area. So let's just kind of let's kind of make the chat a little bit active. I'd appreciate that. Good. Thank you, hey man, I get it. Okay. The reason why we're saying this is that if you like, there's certain things you can do. Let me say it another way. It's like, let's say you're going on a journey, you're walking forward, and you're trying to take 30 steps forward, that's like your salary. But sometimes you take one or two steps back, that is interest that you had to pay on something. That's taxes you had to pay on something and doing it. If you didn't have to do it, it would help you out in that area. So we're trying to show you things of credits, deductions, things you can do to get you further ahead by the end of the year. Does that make sense? Because because at the end of the year, you want to cross over. Crystal?
Yes. So we can get into, I'm going to just get into some of the specific deductions and credits that we can take on our taxes. I mentioned one, which was medical expenses. So a tax strategy, guys, is that if you know that you need to get major dental work done, trying to get all of that done in 1 year, because again, right now, you have to, your medical bill, for you to get a deduction, it has to be 7.5% of your adjusted gross income. So if you're making $100,000 a year, you need at least $7,500 in medical expenses. So we have 3 years, where are my fingers? 3 years to bundle that. And maybe you can't pay for it all, but what we can do is we can take 2022, 2023, and 2024 and bundle that deduction. And if it's over what your adjusted 7.5% over your adjusted gross income, then you can do that. So if the kids need braces, if you know you need dental work, if there's a surgery that you know that is not necessary immediately, try and get that all together. Or if you're a married couple, try and do that all together so that you can maximize getting a deduction for that. So one is the medical expenses at 7.5%. You have your mortgage and interest deduction that you can take. And I'm not going to get into the limits because it's boring, but there are limits to it. But if you own a home, and Pastor George talked about that, there is a interest deduction that you can take for owning your home. But what I want to make clear about that is at Thompson Wealth Management, we don't believe in carrying a mortgage just for a tax credit, because it does not equate to not having a mortgage at all and being able to invest the money that you would normally pay for a mortgage. Pastor George, I'm gonna let you speak on that one.
Gotcha, no problem. And but all I'm saying is, and I understand everybody has a mortgage, and also everybody that's around the country. We live in Los Angeles, so we know what mortgages are here. If you remember, we did a podcast where we had a gentleman from another state in the South, and he thought that the home prices were phone numbers, as in 1818 was 1.8 million, not the 818 area code, or 1213 was 1.2 million. So we understand that. So what we want to do, it's more about having a strategy for your mortgage. So there's something called Schedule A, and we'll also maybe cover Schedule C. Schedule A is mortgage deduction, and usually the largest purchase most people have is their home, and that can be used as a tax saving tool. And then we can give you more detailed information by looking at your to be able to see what the benefits that are. Also, Crystal, before we go to the next point, in the chat we had, it says, so 20%, 22% of your income should be paid toward taxes, and that's how you can pay without owing each year, personal and for business and for businesses.
Ah, I love it. I love it. I love it. I love it.
And then I'll give a disclaimer, and then Danette will say amen. Go ahead.
So there are 7 different tax brackets. It is based on your adjusted gross income, which tax bracket you're going to fall under. And so I would need to, if you are if you're a client of Thompson Wealth Management, I can review your previous year taxes to then determine what tax bracket you are falling under, and looking at the same thing that I just asked you to do, going to the tax estimator, looking at your pay stubs and entering that information. That will then give me a pretty accurate picture of what tax bracket you would fall in. So no, everybody doesn't pay 22%. It is based on your adjusted gross income, how much tax that you would pay.
And everyone, what we're doing right now is we're giving you general information. Specifically, if you'd like to know, we have to look at your we don't know exactly what your income is, and we don't know all of that right now. So if we can sit down with you and go over that, then we can tell you what it would be to bring it in at a good landing, or to adjust it that way. All
Yeah.
right. Good.
Work,
All right.
George.
Gotcha. All right. So then next, if we could go into you want to use charitable, you were doing deductions.
Yeah,
Charitable?
well, did you want to get into charitable? I can talk about it.
Go ahead, you can start. And
So
then
this is the deal. First of all, we are church folks here. So we are, I don't want to say obligated, but I feel an obligation to give back to God what he's blessed me with. So charitable deductions include your tithing, your giving to nonprofit organizations. A charitable donation also includes those things that you give to Goodwill and to, what's the other one? Salvation Army, or the breast cancer store. And I know they used to have one in Beverly Hills. But any of those are considered your charitable donations. You can also donate cars now, cars to kids. Faithful Central, we actually accept car donations also. So all those are considered charitable donations. What we need to know about charitable donations is that they decrease the tax that you owe, and you need to know that the organization that you are donating to is a 501c3 registered with the IRS as a charitable organization. So it's Girl Scout cookie time now, Pastor George. Somebody continuously steals Kim's cookies. You
every year.
you
Yes,
cannot
18 consecutive years. Right.
you cannot donate
We be
or
leaving
purchase
in
uh,
cars. And so she's talking about how you
Hold on 1 second.
I got it. I got it. I got it.
Okay, thank you. You cannot donate your purchase of cookies that you purchased from the Girl Scouts on your taxes. It never fails. Every few years, I got somebody who puts that receipt with their taxes, looking to deduct it. If you received anything in exchange for that donation, if you got tickets to a play, or the kids, you watch the kids at the local nonprofit drama arts place, and you went and you saw that game, or you purchased a luncheon ticket to the women's brunch, those are not deductible expenses because you got something in return. Deductible expenses is something that you give, either cash or goods that you give to the organization with nothing in return. And they should be giving you a receipt for that so that you can prove what it is. One of the other things that we have to take into consideration when we give goods is how much did you pay for those goods? Because the IRS is going to want to know how much you paid for it, because that's going to determine how much you will get in the deduction. The organization will not put that on the receipt. You have to determine what that is. And if you have any questions about it, or you forgot, or you don't want to know what it is, they have tools online where you can kind of verify, right? If you bought you donated a 2000 Buick Skylight, I don't know. You can go to Kelley Blue Book and verify what the value of that was when you first purchased it, if you didn't know what it was. Or a set of Mikasa crystal you gave to Goodwill. There are estimators that you can utilize to verify what that information is. But what I want you to understand is that your tax preparer has no idea. When you give them that receipt, if it says a bag of clothes, I don't know what was in that bag of clothes. I have no idea. So it's up to you as the individual who is getting their taxes prepared to put on there what the estimated value of what it is that you donated was on that receipt.
So everyone, is, we said earlier, and for those who go to papers, you hear me say all the time about giving, and we're doing that as your tithing, as you're giving, you have what you gave there annually. And then also one more thing is you want to keep track, because something that I do, it's something that me and my wife do, is we sit down every year and decide out how much we're going to get, how much we're going to give out, because we actually do that also in our budgeting. It's like how much we're going to spend that year. You know what I mean? Like on all the things, because you remember when people say, hey, let's start saving 10% of our income, start investing, saving 10%. Then after a while, if you start saving 10% or 20%, you begin to save, then you also want to see how much you want to give. It's the exact same way. So you're saying, hey, I'm going to tithe. That's 10%. The word tithe means 10. Then you also do offerings, but we know that givers give. You know what I mean? Like, so I ain't gonna call out no universities other than UCLA. I'm not mad about it. Just my life went there. But we get in all our mail like that. If you give to university, you give to school, you give to different organizations, then you actually want to keep track, because those add up. Then back to what you said about Salvation Army and the different things. Is there $500 at the limit, kind of what they have like in different
Yes.
things? So
There is a
there should be
$500
a certain thing that you should be doing literally every year. Like every year, like in other words, like you should be giving to these organizations and to help people. Because I know during the pandemic, everybody figured out that they weren't wearing the 3-piece suits. So then all of a sudden, boom, like in doing it. So set all that up that you want to be able to do that and have your giving strategy. Do you see how we have a tax strategy? Have a giving strategy as well. Okay. If you need any help with that, call me. I will help you with that. I talk about it all the time. That's one of my favorite topics. All right. Can I have amen for the giving strategy? All right. So can we move on? So I wanted you to go first, though. But I want you to go first because I wouldn't take up the whole time. Because I'm gonna do. Hey guys, we'll do a separate seminar just on giving. But there's the taxes behind that I want you guys also to see. All right. Hey, Crystal, can I ask you a question? What are the miscellaneous deductions? People say, does that work, or what is that?
So that's another thing people always ask. Well, this is
Can I say I want it to be everything else I paid for.
and that's the problem. That is the problem. Is that we would all love it to be the everything else that we got, but the IRS does not. Now, let me make this clear first. The IRS does not accept miscellaneous deductions. No such thing. It does not exist. Okay. As much as we would want it to, but I think because prior to the electronic age and all, like I can remember back in the 80s where you could have miscellaneous deductions. They were specific, but they were considered miscellaneous. And I think people just wish those days would come back. So they always give me a pile of stuff that says, oh, and these are my miscellaneous deductions.
Everything else.
And I hand them right back to them. We can't do miscellaneous deduction. And so there's no such thing as a miscellaneous deduction. Our tax code has gotten so tight that they know what they're going to allow us to deduct and what they're not going to allow us to deduct. And it's pretty clear as to what that is. And you are, as a tax professional, they'll be able to let you know. We can't write off the shoes that you wore to the
business meeting,
AKA ball, the AKA ball.
The business meeting. The business meeting. What about the business meeting?
Not the business meeting either.
Dang.
Now, there is that, but let me tell you though, Danette, there's a caveat to that. There's a huge caveat. If you have a home-based business, or if you have a brick and mortar business and you logo your shirts or your clothing for that, yes.
I'm about to stamp everything.
You can get a deduction for that. You definitely can. You see people who have their cars wrapped that have their business information on it. I think the other day I snapped 3 different pictures of cars going down the 405 freeway. One that was an ice cream truck that said they did parties for kids. Another that said that they did organization for homes and offices. And then the other was a detailer. Three different ones. They had their cars wrapped, and that was advertising the work because I took the pictures. Now, have I called them yet? No, but they're able to deduct that advertising from their cars so that they can get mileage because they're a rolling advertisement. They get their gas, their oil. They can get cleaning, whatever it is that pertains to that car. They can actually get a deduction for that vehicle being part of their business. So that's what we call a tax loophole. We know that our previous head of state I don't even like to say their name, unfortunately, that they had a loophole where I think Pastor George, what did he say? He paid $700 and something in taxes for 1 year. That's what he came out and said. I,
That was it. Since it's a recorded line, and I don't want to get no argument with nobody. There's some tax loopholes that have been utilized by people in the past, and they paid very little in taxes. Yes. And good, but I do want to just say this though. I wanted to talk about retirement plans, but before we do, let's just talk a little bit about businesses, because what you just said about how people do things, and I had one time where someone asked me one time about how all my shirt, like how I monogram them all. I monogram them a certain way so that they are business expenses.
yes.
You know, like in doing things like that. And there's certain things that I buy that do certain things, because when you run a business right now, what the biggest tax advantages are two ways. One is mortgage, home ownership. In that area, I think that area, but I think probably the other where they're the most tax advantages are owning a business. You know what I mean? Like in those different areas, and there's certain things I do in that area. Could you just touch on that? Some of the advantages
Yes.
that you have as a business, and then some of them you have as a business.
Mhm.
In that area. Sorry, go ahead.
Yeah, for sure. So there are approximately, and things shift and change. So that's why I have to say approximate and give that caveat, approximately 750 more deductions and credits that you can take. Not, I'm saying combined if you have a business, whether that be a home-based business or whether that's an actual brick and mortar business, and even online, right? Even an online business, which normally would be run from your home. I see on here, I see RX Nurse Concierge. That logo, I'm sure, was created. Keisha created that, or she had someone create that for her. That was a business expense. And whatever she does with her business, there are certain things that she can deduct for that business.
Right. Can I just use her as an example, just since she's up here? So, like, let's say she had a Zoom account, because I knew that she'd be able to deduct that because it's for the nurse. Does it say nurse concierge? And then also, then we'll just can we walk through a couple of them with her? Like, like let's say she had a car that she had to, I'm saying concierge, let's say she had to go somewhere to do that. That she had to have some clothes that say, I'm sure that you wouldn't make this logo and not have that. I mean, that's a nice logo, isn't it?
Yes, it's
In that area. So can we just kind of walk
Yeah.
through a couple of those with her? But then also, but then the other part about that is, I just want to say this though, a lot of them would be much better. Sorry, you walk through a few, and then I'll say what I'm going to say. I'll say it now, and then I'll say it again later. But then you guys, before we start filling up the chat with, what about I do this, I do that, we'd have to kind of know a little bit more about it, and then it'd help us to be able to do it. But I'm sorry, but go ahead. Let's
Most
just
definitely.
we'll give Danette, we'll give Keisha, we'll give her the same treatment as if she was on the screen today, but we'll give her that one. Right.
Yeah. So she would, like I was saying before, she got her car wrapped with her logo on it, stating what it is that she did, or a phone number on there, her mileage, her oil, her gas, anything pertaining to that vehicle, she would be able to get a deduction for that. She also utilizing the space in her home. Based on the square footage of her home, you get a deduction for utilizing that. Your computer, your iPad, if she had to have a stethoscope to work that business, and anything that for that business, paper for the printer, the ink for the printer, even a portion of the utility bills from the home can be used as a deduction when you have a home-based business. So that's how it increases the amount of deductions that you can receive, and the amount of basically the amount of tax that you owe having a home-based business or having a business. It doesn't have to be home-based, but I'm just saying that you don't have to have, I want you to understand that you don't have to have a brick or mortar, that it can be an online business. So the cleaning of her uniforms, if she had to wear one, that's also a deduction that she can take. The cell phone. So you guys, like I said, it's a lot. It's approximately around 750 more deductions when you have a business that you can take on your taxes. Now it depends. There's caveats to this, and we've been saying this throughout this call, that if you have a corporation, if you're incorporated, there's a different tax filing for that. But again, there are some credits and deductions, and then you're going to be paying yourself. And I don't want to get into the minutia of that because we're going to go down another rabbit hole. But you can own a corporation, or you can have a DBA, which is doing business as a business also, that you are operating from home, a brick and mortar, or whatever that you're going to claim on your individual income taxes also. So Pastor George, just as you said, there are advantages to having a business, and that increases the amount of deduction that you get. And that is one of the biggest things that we do not take advantage of. We will have hobbies that we do that we can monetize, whether you crochet, you sew, even gardening. I know somebody who's selling avocado plants on Facebook Marketplace for $45. They're just taking seeds and growing them and selling them to folks. That's a business. You're
Hey,
generating
oh,
income.
Chris,
Go ahead.
I
There's
want to
further
jump
questions.
in real quick. Can I ask a question for two people? One, I see Aaron asked if you need a certain amount of business income to claim these deductions. And then I have a follow-up question to that and another. So can you tackle that real quick?
Yes, I definitely can. So startup businesses normally lose money, so that IRS realizes that. So you do not have to have income. Normally, they're going to give you about the first 3 years not to generate a lot of income that you're going to be pouring into that business. But you can't go 10
I don't mean to
years.
interrupt you. I don't mean to interrupt you, but I know it says I'll give you 3, but like, let's look at 1 to 2, because then
Yeah.
after a while, you're getting that hobby. You just don't want to go down there. You know, just let you know. You go down.
Oh yeah, they're gonna get you down there. If you have, that was where I'm going to. You got 10 years of no, you have 10 years of no profit. Oh, they're gonna come look at your books. And that's the other thing. You have to keep meticulous receipts when we are claiming these deductions, guy. And it's the front end is easy because the audit doesn't come when you send it in. The audit comes 4 to 5 years after you've already submitted that return. So you want to make sure that you keep all of your records in one place and that you have them together, so that if you get audited, and you don't have to be scared of getting audited, as long as you have your receipts and you're on the up and up, you're telling the truth about it, right? You have records that show that this information is true. Don't be scared of an audit if you have to get audited, as long as your information and what you've done is legitimate. But you want to make sure that you have those records and that you keep them.
Mm-hmm. And you will go blow by blow. I was audited 1 year, and they are not playing. You will sit at that desk and you will punch for punch. What? Here. Yep. Get it. You better keep those adequate records, because they're not playing with you. Here's the follow-up question. Somebody said it in my private. So when you do all these these expenses, can you talk about the difference between the standard deduction and the expenses? Because the question had to do with the standard deduction. How does that play into the business income, business expenses?
Okay, so if it's personal, if you are not a corporation, it goes on your individual return as a Schedule C. And what happens is you can only take the greater of, you can take the lower if you want to. I don't know why you would do it, but we recommend that you would take the greater of the two. If it's the standard deduction, which for 2023 is $13,850. Don't ask me why I have these numbers in my head. It's what I do. It's what I do for an individual. So if your business expenses on your individual return are less than the standard deduction, I'm going to recommend, and I'm not going to recommend, I'm going to do it for you regardless. You're going to take the higher deduction that you can get. So no, you cannot take both. You either do a standard deduction or you do itemized deductions. And that's what that's called. Itemized deductions, when we take the receipts and we add them up and all of that. And then you have a standard deduction and you take the higher of the two. You cannot do both.
Yep. Gotcha. Hey, I got another question real quick. This is from some Hey there. Good morning. I'm an actor. I sell tapes from my home. This is this apartment now a business? Now my business?
You said you make income from selling tapes? If
Yes.
that's the case, that could be considered a home business. And let me tell you this, when you start claiming stuff though, the IRS is gonna get in your business. It's gonna get in your business. So if it's
He
a
said,
hobby,
Are
you
they taking the tapes and claiming the income on their tax returns and then, yeah, I'm
getting
trying to
business
figure that out.
deductions.
Yeah, that's a
like
little bit.
self tapes. She's doing it for auditions, not like selling tapes, like
Oh,
product.
no.
Oh,
Then
I'm sorry. Oh, I'm sorry. Hey, wait,
So
wait.
she
I'm
she
sorry, man.
clarified.
Self, not
Sorry,
Okay.
I
selling.
just wanted to jump in.
Thank you.
Okay,
Thank
so
you.
no, that is not a business. If you're doing audition tapes and you are giving them out, no, that's not a business. You're actually doing that to get work. And that is not a actual business expense. Unfortunately, sorry. I'm sure it probably gets expensive too.
Gotcha. Hey, I'm sorry. I misread it. Oh, good. I see you clarified that. That's self. Okay, gotcha. Hey, that's my fault. That's my fault. I do self tapes, Scott, for audition. Okay, perfect. We got that answered. Danette, did you have another one? And then if not, then we will go to if not, then we'll go to retirement accounts. Before we do, for businesses, as you guys are seeing, this is a whole nother avenue. We got to kind of get a little bit more information, talk to you a little bit about income, and then talk about expenses because certain things that are happening. Because also, well, Crystal, I'll just say it. Someone through it. You guys understand in the state of California, there's something called the Franchise Tax Board, and when you file a business, that there's a fee, and Crystal, the fee is how much?
$800.
Pay that whether it's making money or not, and then because we get phone calls into the church of people asking us what's the way around that. I'm like, how did we stop them from getting those letters? I said, oh, send the money in. That's how you stop the letters from coming in. So just want to let you know with businesses, we just need to talk a little bit about that in that area because we want you to open it, but you open a business to make money. You don't open it to do deductions, but we want to make sure you're just doing it the most efficient way. All right. So now, Crystal, let's talk about now retirement accounts. So let's talk about in that
Real
area.
quick before we transitioned from this, Marietta had asked about property taxes. I wasn't sure exactly, Marietta, what your question is, but you touched a little bit on property taxes, or you talked about interest. Can you touch really briefly on property taxes before we transition to retirement accounts?
For sure. So your property taxes are a deduction, again, not a credit, a deduction. So if you pay property taxes, and that is that is one of the items that are outside of the standard deduction. So you can get a credit for paying property taxes. You just need to ensure that you provide, like I said, keep a copy of your tax bill, particularly if you're in California, because our taxes are so high that I have had people, the IRS question whether or not someone's property taxes were what they are claiming they were. And sure enough, they were, our property taxes are high. So yes, the answer is yes, that is a deduction that you can take for your property taxes, and it's outside of the standard deduction.
Okay, thank you. And back to you, George.
Okay, everybody, and I'll start with Crystal, and then you go ahead and go ahead. Okay, so everybody, there is something called a 401k. There is something called if you work for a for-profit company, a 403b if you work for a nonprofit company, or a 501c3. And then there's something called a 457. That's the county. These are.
Did he stall?
Yeah, he froze.
Okay.
Okay, well,
Chris-
he will definitely come back on. So Pastor George was talking about retirement accounts, and there are several. There you go.
It's choppy.
Okay.
Go ahead, Crystal.
So he was talking about retirement accounts. So retirement accounts, guys, are something that we everybody on this call, you need to be contributing to. When you contribute to a retirement account, it actually that money is not taxed a lot of times when it goes. There's one caveat to that, but that money is not, we call that pre-tax dollars, right? It goes directly into that account. It's taking out of your check prior to you even seeing it, and it's put into that retirement account. That amount that you put in reduces, you don't pay taxes on it, and it reduces your tax liability. And if anybody has had one and they look at their W-2, you might have made, I'm using simple numbers so that I can keep up with the math. If you made $100,000 for the year and you put $20,000 into a retirement account, then you're not taxed on that $20,000, and it only shows your adjusted gross income as $80,000. So that is one of the easiest, most efficient ways that we can utilize the tax code to our benefit, is by participating in one of our in a retirement account. If you do not have a retirement account, how much? So I did see the question. I think this says, how much should you put into your retirement account? You should put the maximum that you can put in there. The limit, I'm trying to remember what the limit is for this year. You guys, it changed.
I know that.
7,500.
There you go, Julia.
7,500
Well, that's
for 50
that's
and
the IRA.
under.
That's an IRA.
Oh.
I'm trying to think of, I want to say it's $23,000. It might be $23,800 for a 401k, 457, all of those that actually go from your check from your employer into that
It's
retirement.
22.5, Crystal, for 2023. Not
Okay.
I don't quote in 2024.
Okay,
But-
20. So that's the maximum that you can put in without being penalized by the IRS. And you should put in the maximum. And the reason why you should put in the maximum is that in retirement, you want to ensure you have enough income to cover your expenses. And that's what we're all about here at Thompson Wealth Management. It is about retiring and having enough money when you retire that you don't have to become a greeter at Walmart. That's my favorite saying. Let's make sure we have enough money in retirement that we don't have to be a greeter at Walmart. Because how many of us, and raise the hands, I want you guys to raise your hands on the screen, have seen the greeters at Walmart and know that the only reason they're there is because they don't have enough money in retirement. I'll put first one to raise my hand. And if you ask them, they'll tell you that. So that is the benefit of a retirement, putting money into a retirement account. The opposite, Pastor George is coming back on. If you do not have that at you back, George? Because he's going to go into more depth. Well, the other option, if you do not have, okay, great. So I spoke some on retirement accounts from employers. Oh,
Yep.
there.
Yes, I am. So no, that's good. It's just important, everybody, just to put money into your retirement account and put in the most that you can. And we do it for tax reasons, but also you need to use that towards wealth building. So you just want to make sure that you're putting money into your retirement the absolute best that you can.
I didn't touch IRAs and I didn't touch SEP.
You can touch them, Crystal. We have about 6-7 minutes to go. I'm not sure it looks like George is having some technical difficulties, but.
Okay.
Yeah.
So if you do not have a retirement account that you can use, that you can contribute directly from your employer, then you would look into doing an IRA, an individual retirement account. An individual retirement account it's not it is money that is also put into a retirement account that you will get. If it's a regular IRA, you'll get a tax credit for depositing that money. in the account, and based on how old you are determines the maximum that you can put into that account. And the great thing about an IRA, guys, is that they give you up until April 15th normally, or whatever the due date is for taxes, to make that deposit for the previous year. So you still have time for 2023's tax year, even though that year has passed, to make a deposit for that year into an IRA. And we definitely recommend that you do that. And contact the office, work with George, and Julianne and Shana will definitely get with you so that you can open up an IRA in order to make that deposit and get that credit for 2023. So if you have not done that, I definitely recommend that you do that. The other thing that we have is a Roth IRA that you can deposit money into. Those are not pre-tax dollars. Those are after-tax dollars that go into Roth IRAs. But the wonderful thing about a Roth IRA, and George has said this, and I'm just surprised we still have the opportunity to do it, is that when you invest that money in that Roth, anything that you receive, dividends and all, you get to withdraw that tax-free. It's the opposite with the traditional IRA. When you take those withdrawals out of a regular IRA, those are taxed at whatever your tax rate is currently. So if you know that in retirement, you might be receiving more money than you are actually making in earned income, a Roth is definitely the way to go, because you're putting money in there and you get it back tax-free.
Right.
So we're-
Hey,
so-
Crystal, you're doing an excellent job of describing that. Man, maybe my internet need to go down more often or whatever, and doing these things. So now everybody, I'm on my phone now. So if I get a little shaky, so I'm holding my phone and trying to hold this other device too and undo this. But make sure that at the bottom line is that we want to make sure that we have a retirement plan strategy and we're utilizing taxes the very best. If you remember, and then Crystal already said it, but in an IRA, you get a deduction. It's like pay me now or pay me later. A Roth IRA, you don't get a deduction. So we have to decide what strategy is the best in two ways. One is if you're not making as much money now and you're going to make more money later, then a Roth is better. But if you make a lot now and you want to receive a deduction, then you want to do a traditional. But then this is the tool part. And then I'm coming to Wayne round after this. Is that if you have a traditional IRA and then your income goes down, everybody, then you may want to do what's called convert some of it from an IRA, traditional IRA, to a Roth IRA. But now, before you put in the chat, because I can't see it anyway, because you already know my internet ain't working, and I'm already trying to hold the phone with one hand. And I'm using this hand right here. See, look, boom, I can switch backwards. See that? Is if you're making more money now, and then you have a year where you're making less, then you can convert some. But we have to work through our strategy on how much we should convert for your taxes. And then that is the point now, is that was doing is this. Some of you are already retired. What should you do? So then there's a couple things we want to look at. Is one, we want to look at, if we are already retired, then we want to say, hey, how do we maximize our income? But then that's an investment question. But then also tax-wise, what we want to do is look at how much we have in traditional IRAs and then see if we want to convert some to Roth and doing them, because it also depends on good and bad years in the markets too. So then there's just a lot of factors that we can do strategy, but we want to do the most efficient tax strategy, and that is us talking about it. But that Roth IRA, I'm going to say something, okay? My hand is raised. You got to know when I raise my hand. There's a few things that happen that I thought just wouldn't. They wouldn't go on long. One is the way you can save in college savings plans and Roth IRAs. I think the government, this is George's personal opinion, this is not written in any fact. I think they're going to stop doing Roths because it's too good of a deal. Imagine if you had bought, let's say, Apple stock or Tesla stock, you bought something and you put in 100,000 and it grew to like a couple 100,000. You can take it out tax-free. I'm just surprised they keep doing that, the deficits that the United States runs. So that's something we want to make sure you're utilizing all the tools. All right. So, hey, one
That's
more
your-
thing. And
Yeah, there you go. I want you to get to one more thing.
one more thing, but then I want us to wrap, and then I promise we'll stick around an extra couple minutes and answer some questions. Is just also, you guys want to make sure you're gifting. You guys already know that. By the way, I got to make a statement. Then I'm done with it. I'm the world's greatest dad at 1/3 the price. So you guys know at Christmas time and all these things, I always told you, instead of buying everybody toys and stuff like that, to buy stock for people. There's also gifting where you gift people. People say, when I die, I'm going to leave this for people. You can actually do it now, and then you can begin to start gifting for people, and there's tax deductions. Anything you want to say about that, Crystal? Then we'll just wrap up.
No, but I did want to say, we talked about retirement accounts, and the flip side of that is that at around 73, there's a required minimum distribution. And sometimes we get the question, why do I have to take that? Well, this is part of the way that the tax strategy was set up through the government. So yes, it is required for you to take a minimum distribution every year once you turn 73. And we want to make sure that you do that, because if you don't do it, then you are penalized for it in the reverse. So it makes no sense not to do it. Now, that doesn't mean that the money has to come directly to you. You can transfer that into a individual account with us at Thompson Wealth Management. You don't have to take it and use it, but that is part of the law with the retirement accounts, that at 73, you have to start taking distributions from those accounts. That was the only thing I had.
You covered it. Hey, everybody, can everybody give Crystal a hand? Everybody give a Crystal a hand or a thumbs up. I can't see it, but just let's give them a hand. Danette for monitoring the chat. Who else? Julianne, and then caught me when I misread something and everything like that. You guys, thank you so much. I want to make sure that everybody also high five wise. I'm giving everybody a high five just in one tuning in. Thank you so much. Also, they're going to put in the chat, meet with George, or actually we're going to take down George. Meet with a Thompson Wealth Management crew or Total Wealth Management crew, and doing that. So if you guys are certain things about income, we said earlier, your debt plan, investment plan, that's all stocks, bond, and retirement and all those things, real estate, and then estate plan 5, and then 4.5 is also insurance protection, but then 4A is taxes. Are you guys seeing how intricate taxes is in everything? So you may want to meet with us, and so we can get a little deeper, because some of the questions that you ask, to make sure you're doing things the most efficient way. I think that what I said earlier about how you bring a plane down, you're trying to land it just really right. Because the worst thing is that not knowing about a deduction that you could have been doing all along and everything like that. And we're over almost on time, and I'll take the thing. We're over a little bit on time and doing this, but for example, I bought a car that weighed over 6,000 pounds. So it was a utility vehicle. And the car I have is like 20 pounds over that. And the reason why it's just a few pounds, because I knew it was a tax, and that was a factor. And also the cost of ownership of this electric vehicle and all the things that I had done, it was very efficient for me to buy that car that way. And the tax deductions for it, and those, and solar. There's a whole bunch of things that I stacked, and I made an exact plan. So I want to make sure that you have that exact same opportunity to have everything that you're making sure you're utilizing. We're not trying to take them from nobody, do not, but you're utilizing all the deductions that you had, and you had all the wealth building things that you have. So if you want more information about that, you can just click on the Work with George and Danette. I will put it, I'm going to turn it, I'll put it over to you. Is there anything else for any other housekeeping things? If not, we'll just stick around, and we will, and then we'll end the call.
Yeah,
meeting.
all of our previously recorded sessions will be posted. I will send that out to all of you that attended, and I'll just send it out in general. We have so many different ways that you can keep connected with us, from reading our blogs, as Julianne put into the chat. Our YouTube videos are also accessible, and are, as soon as this is posted, I will send it out to everybody. So yeah, we want to work with you. Julianne, put in the chat one more time, because it's people are chatting. So the Work with George link is important because some of your questions, as George and Crystal mentioned, are detailed. And in order for us to really help you and help you understand what you need to do, we need to know specifically your snapshot, your financial snapshot, which we call your financial IQ. So thank you everyone for being here, and we're looking forward to working with you in the future. And clients, set a time. We got you.
We'll set up. Good. All right, everybody. I'm back on my thing. So thank you so much. And I'll stick around for a few minutes and answer any other questions.
Yes, indeed. Thank you.